Okay, I got it. You're up, Kevin.
Live streaming. Well, welcome everyone to the Credit and Real Estate Today seminar series. I am here, Kevin Lewis, the owner of Promethean Inc. We are a fintech company helping businesses get access to capital through credit. I'm here with my good friend and colleague, Abigail Bridgeford from Genuine Property Solutions Real Estate.
Hello.
In our 10th installment, it's hard to believe 10 months have gone by since we started this wonderful endeavor. It is our 10th installment of Credit and Real Estate Today. For those of you who are accustomed to meeting us at the library in person, today we are doing full virtual. We do both in-person and virtual typically, but today we're doing full virtual because there have been some safety concerns in the city of Philadelphia. I'm sure there's not much to worry about, but we are concerned for all of our participants, all of the people who live in the city of Philadelphia. For those of you who have been paying attention to the news, there are some dangers that are afoot. So we just thought it would be best to continue. We wanted to provide you a continuity of service, but we wanted to make sure that we were all staying safe. So we are coming to you virtually via Zoom and live on YouTube, as well as our Facebook channels. So thank you guys for joining us virtually. You can always join us virtually. Those of you who like to do in person, though, can meet us in the library. And on the second Friday of every month, you can see us at the Free Library at 201 South 40th Street, Philadelphia, PA 19143. Again, we're not there today, but we hope to be back there second Friday of November. Right, Abby?
Correct. Well stated.
All right. Well, we are here again, my friends. So let's just jump right into it. Today, I'm going to be talking about merchant accounts. You guys are going to know them as something different. I'll introduce that in a minute. And then my good friend Abby is going to finish us out with investing in real estate, which should be some really exciting, interesting information. So let me jump into when we started this series. As you guys know, Promethean provides access to capital through credit. And we started the first part of the year, the first half of the year, talking about personal credit and some of the things that you can be aware of in the personal credit space. And then we moved a couple of months ago into the business credit arena, which is where we get a lot of power. I don't think that, or in my experience, not a lot of business owners understand, one, the power of business credit, two, how to really leverage that business credit, moving you away from personal into business, and the lifestyle that you can achieve using business credit. So I want to talk about that a little bit before I go into what we're talking about today, the specific topic we're talking about today, which is merchant accounts. So for those of you who are business owners, and that should be everybody, and in 2023, you guys almost all have to be an entrepreneur of some sort. You have to have some kind of business. And as the years progress, there has been a huge shift in power and finance in this country. For the first time in the history of the country, the top 1% has more accumulated wealth than the middle class. This is the first time that has ever happened in life, and I'm almost positive we're not going to revert back. I am fairly certain that the erosion of the middle class is all but complete. So that transfer of wealth has been huge. And what I want to impress upon our audience is that has been able to happen because all of the financial laws in this country were written so that businesses can take advantage and consumers would be taken advantage of. Now, I hate to put it that brashly, but that is really how dire it is. If you look at tax laws, if you are a business a business structure, you see that you get more tax breaks and tax incentives if you're registered as a business structure than you would as an individual. I'll give you just a good example. If you own an automobile, if you own a car in the name of your business, and the business owns the car, not you, the business owner, but the business owns the car, you can write off the gas, the maintenance, the car payment, and many other expenses that go along with that car, as opposed to if you're an individual, even if you're an individual that is using your car for business, you can only write off the gas at best. Maybe you can write off a portion of the car payment, but for the most part, the way individual taxes are set up, you can't claim as many expenses for that car as you could if the business owns the car. Now, I want to be clear about when I say the business owns the car. I mean, you go to the dealership and you purchase the automobile in your business name. So Promethean is a corporation. We go and buy cars, and when we go and buy the car, Promethean Inc. buys the car, not Kevin Lewis. Although Kevin Lewis is the driver, Promethean Inc. owns the car, and I get a lot more tax incentives because the business owns the car. So that is one of the ways that business has power. In the credit space, I'll tell you about two things that really impact an individual that is a business owner. One of the things is that you can leverage business credit for a lifestyle. So people talk about this all the time. And by the way, there's a law going into effect that may eradicate this. But for right now, you're still able to do this. So people tell you all the time that you cannot commingle business expenses or business money with personal money, right? So you can't technically use business funds to go on vacation, a personal vacation. You shouldn't. You can, but you shouldn't, right? The IRS has some laws that are written that prevent you from doing that or make it difficult for you to do that, or certainly you can get fined if you do. So you're always told never to commingle your business money, your personal money, right? So let's say you had some income for your business, you wanted to go on a personal vacation and you got a hotel room. Let's say you went to the Amalfi Coast and you got a hotel room there where you're not supposed to use your business money to pay for the hotel when you're on a personal vacation. However, let's say you booked all of the vacations, all of the business trips that you took for your business. Let's say you had a business credit card and you took that business credit card came with rewards points, and you booked all of the trips, the travel for your business on that credit card, and you amassed 100,000 points. You can use those rewards points any way you want. So you can use those rewards points from that business credit card. Now, I want to be clear, Abby, Shavonda, Amber, and et al., you have a business credit card, meaning your business applied and was approved for this credit card. That credit card comes with rewards points. Now, you cannot use the credit card to pay for a hotel on the Amalfi Coast if you're going personally, you and your family are going to the Amalfi Coast. You can't use the credit card to pay for the hotel, but if you've amassed 100,000 points on that credit card, you can use those rewards points to get free night stays at that hotel. So the power is, one, in the fact that you can live a lifestyle off of the rewards points that you get from your business card, and you still will not be commingling funding. The other thing is the amount of limit that you get on that business credit card is going to be 5 to 10 times as much as you would get on the same card as a consumer. So you guys have seen me several times. You know, I do not like to endorse companies because one, they don't pay me, and two, I don't want to be liable for anything that I say here. But I'm going to endorse this company just because it'll have an impact on how you understand what I just said. So if you got an Amex card, a personal Amex card, they may give you, and they give you pretty large limits personally, depending on your credit score. But if they give you a limit, typically they may give you 5,000, 10,000, maybe 25,000 max as an individual. But as a business, they'll give you 50,000 to 150,000, depending on the Amex Black card. You could get an unlimited Amex card and be able to charge $100,000 and $150,000 on that card. That's because, again, all the laws, the financial laws in this country were written so that businesses could take advantage, consumers will be taken advantage of. So they reasonably expect that you're going to be doing more with your business card than you would be personally. So you're going to amass, you're going to get higher credit limits, which means that you're going to amass points at a greater frequency. And typically, where you may get 1 to 3 points per dollar in the personal space, you might get 5 to 10 points per dollar in the business space, which is how you can amass that 100,000 points really quickly, getting those free trips that you can use personally. So I encourage, almost admonish you all, really look at what business credit is and the power of it. That is how these wealthy individuals are getting wealthier and wealthier, because they are acting as businesses, taking advantage of tax breaks and using all of the leverage that credit can bring them. By the way, you guys have often heard Warren Buffett say he pays less percentage in taxes than his secretary. Again, his secretary is filing personal taxes, he's filing business taxes, and so he pays less percentage. He doesn't pay less money, just want to be clear, he pays less percentage. Where she may be paying 33% in taxes, he's paying 15, 10, 7% in some instances, okay? So encourage you to get a business, use business credit. By the way, if you're not familiar, there is a definitive process for establishing and building business credit. And I talked about this when I first introduced it, but I'm going to reintroduce it again because I really, really want people to be clear about how to build business credit and why you should do it. So I'll use what you already know to teach you what you may not be aware of. And that is, when you started your personal credit profile, in this country, you establish your own independent personal credit profile when you turn 18. You can establish your own independent credit profile when you turn 18. And independent means you're not an authorized user on somebody else's account. You can do that. You can do that when you're young. But to have your own independent where you're applying for credit and getting approved, you can only start that when you turn 18. But let's say you just turned 18 and you're establishing your credit, right? If you try to apply for, more often than not, if you try to apply for an Amex card, you're going to get denied because you don't have a credit profile. They want to know that you can pay back money so that they can approve you. But you don't have a way to get proof that you can pay back the money, because most people, I'm not showing slides yet, just because I'm not in that part of the conversation. But and by the way, for those who are not aware on YouTube, a question was just asked in the chat: are there slides to go with this? This is just a conversation I'm having with you, prepping you for this specificity of what I'm going to discuss later. So, so going back, so your personal credit, you're going to establish it. You don't have any credit yet, and no one's going to give you credit. So how do you build a credit profile? Well, you start by getting secured credit cards, right? Phase one or step one would be getting secured credit cards. And a secured credit card means you're going to put a deposit on and you're going to use it as a credit card. If you should default, they got their money already. You use a couple of those, and then you flip them into unsecured. So phase two would be flipping them into unsecured credit cards. And then the phase three would be, then you get an auto loan. Phase four, personal loan. And then phase four would be you get a mortgage, right? But those are all phases, steps to build a personal credit profile that will allow you to get more access to capital on the personal side. Well, there's a definitive process on the business side. So most of us are aware of that process on the personal side, but there's a definitive process on the business side. And that process is to establish what we call vendor accounts. Vendor accounts are companies that use net 30 terms, typically net 30 terms. They'll give you an invoice. So they'll sell you products and services. They'll send you an invoice for those products and services, and you have 30 days to pay the balance in full. That would be the equivalent of a secured credit card on the personal side. So that's the business equivalent of a secured credit card, because most of these companies will give all businesses, regardless of when they started, they will give them a net 30 account, let them order the products and services, and then pay 30 days later, right? The earlier you pay in business, by the way, the better your score or your rating is in business. So that would be your phase. There's actually a phase one where we talk about business legitimacy, and that's making sure your business is set up correctly. But the first part of building and establishing the credit is actually our phase two, which is called vendor accounts. And now we're going to go into our phase three, which is called merchant accounts. And now I will share said screen with you all. By the way, you guys know us, Promethean Inc. This is our address. This is our phone number. This is our website. And this is our email address. So let me make this a little. All right. So let's go into merchant accounts, and we'll skip over that for a minute. So a merchant account, we call them merchant accounts in the industry, but you guys might refer to them as retail accounts. Retail accounts are simply any companies, particularly big box retailers, that will give you not give you, because they're going to charge you, that will issue you a credit card and or credit line. Now, again, I'm going to go out on a limb here just so you can cement this in your mind, but stores like Best Buy, Home Depot, Walmart, Target, Staples, all of those retailers have business credit cards that you can apply for in your business credit card. Now, I'm going to back up a little bit. If you are applying for a credit card from I'm going to call them merchants. Again, you guys may know them as retailers, but we're going to call them merchants. If you're applying for a credit card from a merchant, you know you're applying for business credit because of this second highlighted thing here that says, if the application asks for the EIN first, it's business credit. If they ask for the social security number first, it's personal credit. So there are many times where you could walk into Staples, for example, and Staples will issue you a credit card, but Staples will let you put anything that you want on the front of that card. So you can put your business name on it, but it doesn't mean it's a business credit card. If on the application you fill out, if they ask for your EIN number first, most of you are doing these applications online, so you'll see they ask for some information and then they'll ask for your EIN number. If they ask for it first, then it is business credit that you're applying for. If they ask for your social security number first, then it is personal credit that you're applying for. So keep that in mind. So when you go into these retailers, merchants, when you walk into these or do it online, again, most of you will be doing it online. When you apply for credit online, apply in your business name. Now, when you are doing the application, when you're doing the application, there's a few things that you want to be aware of that are not here. One is when you apply, there is, in 2001, the federal government passed the Patriot Act. The Patriot Act, part of the Patriot Act says that many lenders must ask for the Social Security and date of birth of the owner of a business, even if they're applying for business credit. That's just for identification purposes. So just because you put your Social Security number and date of birth on a business credit card application does not mean you're applying for personal credit. It also doesn't mean that you're personally guaranteeing that credit card. It is just a way for the banks to make sure the business owners are not funding terrorist activities. It was set to thwart the finance of terrorist activities. So again, remember, if the first thing they ask for is the EIN number, then it is business credit. And only if they say you have to personally guarantee this, will you have to personally guarantee. So if there's no box that says, do you wish to personally guarantee, then just because they're asking for your social and date of birth doesn't mean that you're personally guaranteed. All right. Credit cards are just like vendor accounts. The earlier you pay, the better your credit rating is. So you have a 30-day cycle typically on most credit cards to pay the bills. Now, these cards and credit lines, many of them are revolving. So the difference between a vendor account and a merchant account is a vendor account, you have to pay the entire balance on the due date of the invoice. On a merchant account, it is revolving, so you can pay some of it. You don't have to pay all of it. But if you pay all of it, the earlier you pay, the better your business credit rating. If you get let's say you got a Staples credit card, business credit card, and it had a $5,000 limit, you charged up $2,500, it's due in 30 days. If you pay $2,500 and you pay that in 14 days, you are going to have an A rating. If you pay that $2,500 in 21 days, you're going to have a B rating, and anything less than that is going to be C or lower. And if you don't pay the full balance, you are carrying that balance over, which means that your credit rating is going to go down. Now, it doesn't go down as dramatically as it would go down if this was personal credit, but it still goes down. So my advice to you is never charge any more than you can pay within 14 days on a credit card. Just like in the vendor accounts, don't use more or don't order more products than you can pay for in a 2-week period. Cool on that? Cool. The other thing you want to be aware of is not all merchants, just like not all vendors, report to the credit bureaus, and the ones that do report may not report to all 3 credit bureaus. I'm going to put you guys on the spot. I'm not expecting you to remember this, but Amber, do you remember what the 3 major business credit bureaus were? I'm not expecting you to remember. So if you do remember, you will surprise me. And it'll be an exciting surprise, but a surprise nevertheless. I'll take that as a no. There's 3 of them. There are several of them, but there are 3 majors. All right. So in order of most notable, oh, wait a minute. Shavonda Lewis knows. She raised her hand. Shavonda, you can, oh, do I have to take you off mute? Oh, no, there you go. What are they?
Would it be TransUnion, Equifax, and Experian?
So those are great. Those are the 3 major personal credit bureaus. That's awesome.
Okay.
Thank you for remembering that. Remember that. So the 3 major business credit bureaus are Dun & Bradstreet, which is the most notable, and they are the one that actually issues you that Paydex score that gives you this rating. that A, B, C, D, or F. Then behind that is Experian business, and behind that is Equifax business. And those are listed in the order of most notable to least notable. So when you get these credit cards, before you apply for these credit cards, I would suggest you call the companies and ask which bureaus do they report to, and make sure they're reporting to, if at minimum, they want to be reporting to Dun & Bradstreet. You would hope that they report to all three, but at minimum, you want them to report to Dun & Bradstreet. If they don't report, or they tell you that they don't report, ask them, will they report? Would you report my account to the business credit bureaus? Some of them don't report because the client doesn't ask. And if the client does ask, they'll include you in batch reporting with all of the other accounts they report. So you have to ask. Now, if they don't report to any business credit bureaus, it is going to be challenging for you to bolster your business credit profile. I'm going to give you an example of a conversation I had 2 days ago. This happened to one of my clients. So this client has an 800 personal credit score. They have a credit line at one bank of $25,000. They have another line of credit at another bank for $40,000. They have 3 credit cards totaling $110,000 worth of credit, but they went to qualify for this loan program, and the loan program said, we're going to give you a certain sum of money, but you have to get a loan for this other sum of money. And they went to another bank to get the sum of money was $25,000. I'm sorry, $17,000. They had to get a loan for $17,000 to qualify for this product. So they were going to get a $35,000 grant, but they had to get a $17,000 loan, secure a $17,000 loan to make sure that they qualify for this grant program. Anyway, they got denied by the bank because the bank said their business credit was not substantial enough. And he called me and said, Kevin, how can that be? I've got what amounted to about $165,000 worth of credit already and a great rating. But none of those companies that he has that credit with are reporting to the business credit bureaus. And he did not ask that question. By the way, one of those lines of credit he's had since 2020. So none of the credit that he has is reporting to the business credit bureaus because he never asked them. He didn't know. So he never asked them. So I'm saying to you guys, so he's not going to, this is $35,000 free dollars that he's in real estate. So it's $35,000 free dollars, and it's in real estate investing, which Abby's going to talk about shortly. $35,000 free dollars that he cannot get because he does not have business credit reporting to the business credit bureaus. That said, make sure you ask before you apply. Wow, I really beat that horse. Okay, here's the mechanics of getting those merchant accounts. Apply for merchant accounts, get at least 4. So 4 different companies. When you get the credit cards or the credit line, use a small amount of the credit. Don't use more than 25%. Now, this business credit doesn't have the credit utilization issue that personal credit has. This is a suggestion from us because I want you to be able to pay your bills within 14 days. So don't use, if you get a $5,000 limit, don't use $5,000, use $1,250. Because like I said, I want to make sure you can pay the bills. Pay the bills 2 weeks before the due date. Oh, ignore that bullet, your paydex. And then wait 90 days before moving to the next phase. And the reason you want to wait 90 days is the one caveat about business credit is that unlike personal credit, it can take 90 days before your accounts report to the business credit bureaus because of the ways that merchants batch their reporting. So they may have less, like when I say batch the reporting, I'll give you an example of what that means. So let's say Staples, let's stay with Staples. Let's say in the month of October, Staples clients only use $100,000 of credit amongst 10 different companies. In the month of November, though, that might change to $1 million over 100 companies. Staples may wait because it costs Staples money to report to the business credit bureaus. So Staples may sweep the October's payments or the October's history into their batch with November. And they're going to report, because all they report is not the due dates, but they report that this client paid 20 days early or 14 days early. So they may sweep all that batching. So you want to give it time for them to sweep your account into whatever batch they're going to use to report to the business credit bureaus. So typically that takes no more than 90 days, but it can take up to 90 days. So get 4 of those accounts, use no more than 25%, and then wait 90 days before you go on to the next phase, which I will talk about in our next session in November. All right. I know I talked a lot. Does anyone have any questions, comments, concerns, issues, gripes?
Anyone can raise their hand. Okay.
Okay.
We have a question here.
I think that's Amber. I'm sorry. Is that Amber who's raising her hand?
We have Old Bridgeford.
Oh, that's Orlando Bridgeford raising his hand.
Hey, Kevin, how you doing today?
Outstanding. How about you?
Excellent. So the question is regarding that scenario where the company did, or the companies that you have these various credit lines with, and you've built some type of history, but they haven't been reporting it to Dun & Bradstreet, Experian Business, or Equifax Business. Have you ever heard of a scenario where a client called them up and asked them to report what they had already established to one or all of these business credit reporting agencies, and they were granted that request, even though it typically wasn't being done?
Absolutely. We do it all the time because a lot of our clients come to us after they have gotten some of this credit. And so we do it all the time. And we typically make a call with the client on the phone and ask them to report. And again, most of the time, or many of the time, it's a 50-50 shot, but the times that it has worked is just because the client had not asked prior. Maybe they didn't know, or they just didn't do it, but they didn't ask prior. And when we asked, the company said, absolutely, we'll put you just in with the batch. And again, I go back to what I was saying about how they report. So they don't report the due dates. They can go all the way back, and all they're going to report is that this client has had this credit from October of 2021, and the average time of pay is 14 days. So they have an A rating. Yes, we do it. We have done it consistently.
Okay, so typically you could expect, if you were being granted that request, for them only to go back a couple of years to report, or would they typically, if you asked them, go back further?
No, they're going to go back as far as when you started the relationship with them. So if you
Gotcha.
started in 2016, they're going to say, since 2016, their average time to pay So they're gonna, the way the file is set up, they're gonna send it in a file. They're not gonna say this, they're gonna send it in a file. And the file, just think of the file as an Excel spreadsheet. So it's gonna have the company name, EIN number. It is gonna have the, it's gonna have the date that they started with the credit, and it's gonna have the average time of payment. So if you started in 2016, they're gonna say October 16th, 2016, and the average time of payment is 14 days, keeping in mind what I said in the session, the previous session, that you can fit. Oh, let me end that, and then I want to say something after that, but I want to make sure I answered your question. So Orlando, did I answer your question thoroughly?
Yes, it was answered. Thank you.
Okay, perfect. I want to make you guys, or bring your attention back to something I said in September, and that is you can fix issues in the same cycle in business credit, unlike you can in personal credit. What I mean by that is, let's say in personal credit, you missed a payment, or you made a payment 31 days late. So they reported you late, they reported you 30 days late on your credit report. It can take you up to 24 months. No, it's going to take you 24 months. If your score drops 60 points, it's going to take you 24 months of paying that same account on time to get those 60 points back. That's 2 years. In business credit, they do averages. So if you paid 30 days late in business credit, all you need to do next time is pay 30 days early. And you can pay 30 days early over any account, but let's take that one account. So again, Orlando, let's say Staples, because I only want to endorse one company. So let's say Staples. You got a credit card from Staples on October 15th of 2016. They hadn't been reporting. You call them October 15th of 2023, say, hey, I noticed that you're not reporting to the business credit bureaus. Would you mind reporting? They say, yes. They're gonna report from the 2016 date. They're gonna report that that's when it started, and they're gonna report they paid on average 14 days. That means if you pay 30 days late one time, you should pay 30 days earlier the next time, or at least 15 days earlier, so that it averages out to be 14 days. Because again, the quicker you pay, the higher your Paydex rating. Good question. Any other question? Okay. Well, if there are no questions, concerns, issues, or commentary, I appreciate the time that you've allowed me to spend. This has been very comfortable for me. I get to sit here I'm in my home office today, not in my away office. I'm in my home office today, sitting in my ergonomically comfortable chair. And probably equally as importantly, I'm in the safety of my home in a part of Philadelphia that does not seem to be in the same amount of concern as the other parts. So thank you for allowing us to appear in this forum. Thank you for joining. I think that's Luke. Luke, thank you for joining. Everybody else on the call, Amber, Shavonda, Orlando, Abby, I mean, you had to be here, but thank you for joining. And I'd like to turn it over to my esteemed colleague, that is Abigail Bridgeford from Genuine Property Solutions Real Estate. She's got over 30 years in the real estate space. She's an investor in her own right. Her and her husband have built a wonderful company, an amazing family. She's very well versed in this space. So I know we're in for a treat. I'm going to sit back. I'm going to go on mute here and take it away.
All right. Well, thank you, Kevin, for your kind words. I will say that I always love listening to happened, everybody? Are we here? Okay, it's just being able to see everyone. Always enjoy listening to Kevin because he has such great informative information. So what we're going to do today is we're transitioning. We would like to have, if I can, entertain you just for a second. I'm going to tell you a story, a little bit about my childhood as a child, because down North Carolina, we had a house down there, my grandparents, two people, mother, father, and 10 children, 2-bedroom home. And every day, whenever we went to their house, right by the door, there was something. I want to see if anyone can guess what it is. I'm going to try and describe it as best as I can without giving it away. It was something that would sit right by the door. You would walk by it every time we go down there. It's about this high. You can see my hand. And it would sit there right by the door. And every year when we go down North Carolina, I always would see a change in it. That it was always a change. And then one particular day I went there and it wasn't there anymore. Now, I know it's kind of vague, but I'm just playing a game. I want to get an idea if you can tell me what you think it might be. Something that would sit right by the door, that every time you would go in and out the door, you would see it. And it would not be the same each and every time when you go by. Just playing a game. Let's see if anybody would want to try to amuse me.
It had to be a tree.
A tree? Okay. Okay. Oh, wait, someone said a piggy bank. Oh, well, how about that? Somebody said a piggy bank. And you are right. You are right when I tell you it was a piggy bank. Very good. I'm going to show this in full screen. But yes, it was a piggy bank. It was a jar that sat similar to this. It was the shape of a Coca-Cola bottle that sat right by the door. And every day we would walk by and people put their coins, whatever coin it was, you would put it in there. So my grandparents had a good little investment going on. That was their method of putting pennies away, as it were. And I guess with 10 children, you had to find some way to save money in and allow anyone and anybody who walked by that bottle to put what they wanted to put in it. So today, what we're going to discuss is we're going to talk about investing in real estate. We want to really hone in on the word invest because that's very important. In our economy today, I don't have to tell you, the scene of this world is changing. You used to be able to go to the store and get several bags of groceries for a few dollars. And now, of course, you might come out with one bag with paying the same amount of money. So our money doesn't go as far as it used to go some years ago. But real estate is still different. It's a different vehicle in which a person can invest money and to get a good return on their investment. So let's talk about real estate. So on our agenda today, what we're going to cover is we're going to discuss financing, which is monies that we're being borrowed from lenders. We're going to talk about the rates and the various rates that comes with this financing. And we're also going to talk about various types of properties that a person might want to invest in, because now our properties are the same. And then we're going to discuss perhaps the service that perhaps you might be interested in, which is managing property. I will encourage everyone, please, if you can, let me see if I can minimize things just so I can see all of you in case anyone has any questions. Let me just give me one second.
So Abby, if you'll allow me to be the moderator so you can keep the screen at full screen, if somebody
that'd be great.
in the chat or somebody raises their hand, I will make you aware. Is that
Great, wonderful, thank you.
I'm here to serve you.
Oh, you know what? I just love it. I appreciate it so much. Okay, so financing is important when it comes to investing because most people do not have hundreds of thousands of dollars just sitting in the bank. Okay, so we want to use leverage, or which is considered other people's money, which is the banks. So when we're investing in real estate, we're going to talk about primarily in this instance from two perspectives, whether you're buying a property as an individual or whether you're buying it as a business. So when we look on the personal side, which is the left side of our screen, you're going to notice that generally speaking, when you're buying property as an individual, for investment purposes, it's important to know that FHA is not the loan product that you will be getting. Now, most of us are familiar with FHA. Federal Home Loan Association has a product that allows individuals to put 3.5% down. It allows them to have greater debt to income ratios. And so therefore, this type of product is a product that generally allows first-time home buyers to be able to enter the market. And in this space, it allows them to be able to keep as much of their money as possible in their pockets, while at the same time being able to try to compete. Now, that's what FHA is generally for. That those are people who don't have the credit's not the best. They don't have as much of a down payment. As we mentioned, they only need 3.5% down. And they are allowed to have a lot more debt than perhaps maybe a conventional product. So for the purposes of investing, however, you cannot use FHA, because FHA also means you have to be an owner occupant. You have to live in the property. So from an investment perspective, generally you're going to need approximately 20 to 25% down of your own funds on the individual side. And the rates will also could possibly vary. So at this time, since I can't see anyone, are there any questions that anyone might have before I move over to another segment?
I have a question, Abby.
Yes, how can I help you?
Can you debt finance the 25% on an investment property?
You can if the debt is on a on a primary residence. So if you have a property already and then you have a home equity line of credit, you can debt finance. You could take the debt from that house and you can put that as a down payment on another property.
Okay.
Now,
Go ahead. Go ahead.
No, but the vehicle that you're discussing is more on the business side of financing versus that of an individual. So as if I'm understanding your question.
I use a credit card to finance the 25%, and or can I take out a loan from a bank to finance that 25%?
Right. So those options are generally used on the business side, which we're going to discuss in a minute. On the individual side, you can do it. It will be extraordinarily high to do it. And in most cases, on the individual side, if the bank knew that you were borrowing money from another credit card, they would not let you do it. So if you have a credit card and you go and take out funds, let's say $5,000 or $10,000 as a cash advance from your credit card to purchase a property, if you're borrowing additional funds, the bank is going to say no. They're going to say no as an individual because you're increasing your debt to income ratios. They don't want to see that you're going to use funds from a debt for your down payment. They're going to want to see some seasoned funds in your account. So that takes us over on the business side. So when financial planning, as you see on the business side, it's a little bit different, because if you have a business and each member of that business has a different ownership interest in the business, then you can perhaps do more debt financing, because now each person is not being, the property is being purchased in a business or a different entity. It's not the individual themselves. And what's even important is to keep in mind that all the expenses associated with a business buying property and investments names are going to be higher. It's just going, everything is just going to be higher because it is for commercial purposes. But now remember, it's all investment. So we're talking about whether you're buying a house as a person or whether you're buying a house as a business, it's going to be some cost, more costs associated with it than if you were buying it as an owner occupant. Did I answer your question, Kevin? I just want to make sure that I addressed it.
Thoroughly, you answered it thoroughly, and I do appreciate it.
Oh, no, thank you so much. And if there aren't any additional questions, I'm going to move on to our next slide. So the types of property is important to think about when you're investing in real estate, because there are pros and cons with whatever property you invest in. And so on our screen, you'll see over on the right, there's what you consider your single family house, just a traditional house. You also see a multifamily where you see the two doors where you see that more than one family. And then we also have what's considered commercial. Commercial real estate is considered anything that's 5 units or more. And a multifamily is anything that's considered 2 units, 2 to 4 units. So single family is 1, multifamily is 2 to 4. And after you get past 4, it goes into what's considered commercial space. So if you are a new investor, you're a person who maybe perhaps you already own your home and you're thinking about buying another property for investment. Well, a single family, the pro for that is that you just have one of everything, one heater, just one everything, one stove. It's just one tub, one everything, right? You have one family to interact with on a day-to-day or a month-to-month basis, however your arrangements are with your tenants. And the insurance is a little bit more reasonable just to insure a single family home on an investment level. Now, what might look like cons, and cons doesn't mean it's bad, it's just, it might depends on all about your perspective and what your aspirations and what your goals are. So as a con, you might say, well, a single family home just limits my income. I could only rent this one house out for $1,500. That's it. I can't do anything more with it. That's the maximum income I'm going to get from this property. And of course, if the property is vacant, then you have no income because there's no other income to be received from this property. And as far as a timetable for profit, single family homes tend to take longer for you to see and realize that you're gaining any profit, because from the time you purchase the property, which is the acquisition cost, and also other costs, for those for the purposes of maybe totally new to real estate, acquisition means the money that you spend to buy or to acquire the property. So you have the sale price of the property, you have the closing costs of the property, which is expenses associated with buying the property, whether it's title insurance, homeowner's insurance, transfer tax, your commissions to your real estate agent. All those things are considered closing costs. So when you put out all that money up front, now remember we said for investment purposes, you need about 20%. So if you have a $150,000 house, you have to put out $30,000 just to purchase this property, and not to mention whatever closing costs that might comes with that. So it may take a little time before you see that $30,000 come back, especially if you're renting the house out for $1,500 a month. So that's a single family residential. Now, as we move to a multifamily, then the pros is, okay, using these two doors, using as an example, you have a situation where if one, you got 2 incomes now, right? Now we said 2 to 4. So if you have a triplex, you have 3 incomes. You have a quadruplex, you have 4. So, and all in one building. So that's a pro. You're getting perhaps 2 to 4 incomes simultaneously. And so you need less to have more. So what that means is if you a person, you're an investor, and you say, I want to have 20 units. Well, in our for our purposes, 20 units means 20 different families. So if you were a single family person, you would need 20 different houses. Whereas if you bought duplexes, you only need 10. So you have 10 houses with the same amount of units as a person who owns 20 houses. So that's one of the pros of multifamily. So you might say, well, I want to have 20 units. You can actually get, 5 quadruplexes. Just have 5 buildings that have 20 units, 5 times 4. So that's one of the pros. And the pros is that you can have a 2-in-1 situation. So you can live in one unit and rent out the other unit. That would be a good investment for you. Basically, you have someone paying either your utilities or they're paying your mortgage. So those are the pros of multifamilies. Now, what may be considered a little bit of a lesser pro is that you have more repairs. So if you have a unit that has 2 heaters, then you might have 2 heaters that needs to be fixed. You have 2 of everything, or 3 of everything, or 4 of everything, depends on how many units you have. You typically will find that your homeowner's insurance is going to be higher because there are more risks involved with having more people in the same building. And then you have multiple personalities. That means you have a family that has animals, you have a family that has kids, you have a family that has their own business in the house, they have family that has, so it's a lot of dynamics that goes on when you have more than one unit that you may want to take in consideration when you're doing investment properties. So before I move on to the next section, anyone have any questions about the single family residential or the multifamily residential that we discussed? Okay. That just makes me feel like I'm really going over this information thoroughly. Thank you. All right. So the other issue we have is commercial, which generally speaking, as a new investor, you don't generally jump in being a commercial investor. But one of the pros when you have commercial space is that you can charge much higher rent. People expect to pay more when they live in a building that has a lot of amenities, particularly condominiums, or if it's a place that has a shopping center nearby or any other type of real amenities, even located on the premises. And then there's also a lot of great tax benefits because most of the people who buy commercial spaces are people who have C Corps or other type of corporations. They're incorporated and they like to take advantage of all the benefits that comes with taxes. Some of the cons, as we already know, is everything's just going to be more expensive all around. Everything about commercial space is higher, and there seems to be greater risk because you have more people. You're more likely to have slips and falls and other types of liabilities that comes with ownership when the more people that you have using that space. So my husband has provided me with a chart here that I thought would be nice to kind of share with you all for a second. And it's important because the purpose of buying real estate is so that you can get what's called a cap rate or capitalization rate, meaning you want to have a property that's going to be allowing you to grow, to earn money. You want to see what rate this money is coming back to you at. Now, on the surface, if you will look at these cap rates, let me ask you something. Do your banks offer you any of these rates right now? Even the lowest rate here, which I think
Definitely
is
not. Definitely
5.88, right?
Absolutely not.
So if you were to put the money in the bank, you wouldn't even get these rates, okay? And so the idea of real estate is that there's a formulation in which we use to help you determine if a property is a good investment. So you'll take the annual expenses, which we see, let's take property A here. We have this house is worth $1.5 million, and this property produces $100,000 worth of income. So we take the annual expenses and we're going to subtract that from our annual income. And then we're going to divide it by the market value. And that's how we get the cap rate. In this situation, all of these properties in one way or another could possibly have really excellent cap rates based on the location, the size, and the use of the property. We're not going to go into it extensively today, but I'm just giving you an idea that there are formulations that we need to determine whether what we're doing or what we're buying is a good investment. And then that's how we would do it. We would take the property, and I'll repeat that again for those who may be taking notes. You take your annual expenses, you subtract that from your annual income, and then you divide that number by your market value, and that will give you your cap rate. When you get to cap rate, you actually have to move the decimal over to the right by 2 spaces in order to get it exactly. So if you was to do the first one, it'll come up to like 6.16666 or something. You know, you have to move it over and it just rounds it up to 6.17. But it just helps us to see that don't go into real estate investing thinking, oh, okay, I know this property is going to give me money right away. We have to think about what the property is worth, what amount of money that the property is going to be generating for us, and how much we have to spend to keep the property going. So I'll give you some examples. So annual expenses could be your homeowner's insurance, your utilities. It can also be with any type of repairs. These are things that you pay every year to keep the property up to par. Now, of course, we all know real estate taxes. Market values change. So you can have a property that's 1.5 million now, but perhaps let's say they put a graveyard across the street from the property, and now all of a sudden the values plummet. Or they might put something that they consider, like, I don't know, for some people, Walmart or something is a big deal to them, and it makes the value of the properties go up. So you have to keep in mind when you're, as an investor, really pay attention to what's going on in your neighborhoods, and so that you can determine whether the value of your properties are going up or perhaps the value of your properties are coming down. You have any questions or comments on that before we move on? I'm sorry for asking, but I have to ask because I can't see everyone right now.
No, so no one has a hand raised. I'm going to raise my hand
Okay.
verbally. So your cap rates, do you, when you're getting ready to invest in an area, would you suggest we look at the average cap rates to see if the cap rate of the property we are prospecting falls in line with those average cap rates?
Yeah, I think that's a good idea. I mean, when you say average, it's kind of hard to know, particularly what, and I'll tell you why. The value of the, okay, for our purposes, for real estate agents, we generally look at market conditions for 6 months. So if you're going to do that, which is, that's fine to do, every 6 months, you have to analyze and see what was the market like in order for you to come up with that average. So because the market, even an appraiser generally would look at what happened in the last 6 months within 1 mile radius within, and by doing that, then you're able to see or get a gauge as to, okay, so this property is going to give me 6% because it was 6% last 6 months ago, it was 6%. And, or it might, or you might even start seeing that over time the cap rate was going down, or the vice versa, or that you see the rates are going up. So if you do that, then I would say just to do it incrementally in a 6 months increment. I wouldn't go back by years because a lot can happen within a year. And within, yeah, so you can do, that's a great thing. It's good to average it out to get an idea. Me personally, I think any cap rate above 8 is like fantastic. That's just my opinion, but some more savvy investors might want 10 and 12, 13%. Of course you do. But it's just a good idea to think about really what is it that you're looking for realistically, because real estate generally do appreciate, but there's times that it does depreciate. And then the other I think is in the banks, since we already established that the banks don't really, they're giving you like 0.0075 or 0.00, I see 1% interest on a savings account. So for some people, a 4, 5, 6% cap rate is excellent. So it all depends on, I feel personally, even as we look at the examples that we had before, the more units you might have might help aid with you having a greater or more robust, cap rate as well. So, and of course, the best thing to do is to buy anything that you buy, try to get it below fair market value if you can. Never buy anything above and over fair market value, only just to find that you'll be upside down in the value of your homes. Because that's one of the problems that many people, especially in 2008, that they experienced that they bought a house, let's say for $100,000, and then when the economy fell from underneath them, the house was worth only $80,000. So now they're at a $20,000 deficit, but they still have to pay that back. So you have to be really careful. And I will say, the reason why the banks, if we were to go back just for a second, the reason the banks are as hard as they are with their lending practices is because you have to put yourself in the mind of a bank. If you have 2 houses, now we're talking about investing in real estate. So let's just say hypothetically, you already own a house. That's the roof over your head. And you decide you want to spend, some money, let's just say $100,000, just for illustrative purposes, for an investment property. And this investment property has, let's say, the cap rate like of the first one, 6.17. So you're doing good, right? But if you fall onto hard times and your finances bottoms out for whatever reason, which of the 2 houses are you going to let go? Anyone could tell me. Which is, you could put it in chat if you want to. Which of the 2 houses you're going to let go? Are you going to let go of the house that you live in or the house that someone else lives in? Right. You want to let the house go that someone else lives in because you always want to keep a roof over your head. So the bank views that as a risk. It's such a big risk to them because in their minds, they're saying, wait, she already has this house. I know she's going to pay that because that's the roof over her head. But now this one, if she doesn't pay it, then we're going to end up being stuck with this house. That's why they ask you to invest more on it. You put 20 to 25% investment in it because it's just such a high risk. Because if there's no tenant in that house to pay that mortgage, you have to pay the mortgage to where you live and the mortgage on that building too. So you have to look at all of these things from the perspective of a bank. So that's why with investing, you want to, prepare yourself properly so that you can invest and be successful in. Okay. So as we
Abby,
Yes.
I don't want to hijack your conversation. Just want to say this about investing and cap rates.
Yes.
So encourage you to keep in mind that inflation usually runs about 4.5%. So when you're looking at cap rates, although your bank may be giving you 0.5% or 0.005%, for a 3%, 4% cap rate might seem good. However, if it's not beating inflation, typically in any investment that you make is not beating inflation, which is about 4.5%.
Wow.
Here,
That's
you're going to have a challenge with that investment.
Thank you for mentioning that. Yeah, it's a lot involved with, and that's why it's also important to really work with a good real estate agent. I happen to know one. Because knowing the market is going to be real key so that you can take all those types of things in consideration. So one of the issues that I run across is people say, well, I don't want to invest in real estate because I don't want to manage it. I just don't want to be bothered with it. And I can understand that because as we discussed already, there's a lot, it's enough to do just with acquiring it, let alone making sure that everything stays up and running. So I want to address some of the myths of real estate and the abilities to be able to manage it. first of all, the services that a property manager provides are and can be a la carte, which means you don't have to have a full package. If you're a person who have some type of skill set already where billing or collections or telemarketing or customer service or anything of that sort, you may actually be able to just get the services of a property manager when it only comes to evictions. I mean, otherwise you might be okay with just collecting the rent, giving the person a receipt, making sure the money goes to the mortgage company. So you can get from just a one basic thing to a whole entourage of items. So for instance, if you might say, well, I just want you to do everything. Okay, in that case, what we do is obviously we get the licensing that's or the permits that's required by your locality. It's also important that we, make sure you get all the information about your utilities and pay all your utilities, pay your insurances, pay your taxes. We can also find a tenant, put the tenant in the property, all those types of things. And then of course, collecting the rent, making sure you get your proceeds. And then if there's any repairs, repairs can be made as well. So just don't feel as if, when you get a property manager that, it's going to be so expensive. You can tailor what it is that you want the property manager to do for you. And the fees will commensurate with what you ask them to do. So if you just want them to collect rent, then if they might just charge you a smaller percentage of your rent for collecting it. But the fees can go from, and I've seen it go from 10% of the rent on up. I guess it just depends on what services it is that you want. And so look around for a good property manager and to have that person, particularly if you have a lot more units. Like if you have one unit, it's probably good to get your feet wet a little bit and learn how to manage and see what it takes to own investment real estate. And the benefits that comes with having a property management company are vast. For one, it takes the pressure off of you as a person as to all the things that has to be done because you have someone else in your corner that's going to help you to ensure that these things are all cared for. They'll make some suggestions to you. They'll let you know of upcoming expirations of licenses, and they'll also make recommendations as far as some general repairs and things of that sort. And at the end, especially if you're an absentee landlord, which means you do not live in the same city, state, or area of your property, you might want to consider property management services because then you have someone who's there in that area who can watch your property and take care of your property for you while you're across seas or another state or anything of that sort. So property management is a nice way to have services and care while you invest. Because I get it, we all have busy, we all have things we want to do, and we might feel like I can't have an investment property. Well, you really can. I would also mention that if I was to surmise it in one sentence, the sky is the limit. You can invest in real estate. You can do it. Now, I will stop share for a minute. I want to give you all a scenario that goes unused, and I want you to really understand that this is something you can do if you're a person who do not own any real estate at all. It might be best for you to start off investing. Now you might say, Abby, I don't understand. How does that make any sense? Okay, well, you start off investing by buying a property as an owner occupant. Buy a property that you can live in, even for a short period of time, as an owner occupant, so that you could put 3.5% down instead of putting 10 or 20% down. Okay? Move into that house, live in the house. You're not required to stay in there for any long periods of time. Now that becomes your investment property. Because now you go and buy your single family home or people like to have a single home, nothing attached to either side or whatever the case might be. In other words, do things the opposite way. Most people go into, I'm gonna buy me a house, and they buy themselves a house and they in their house, and then the family comes and then they gotta get a bigger house and they gotta do all this all over again. If you don't own real estate, go in it as, okay, instead of me, that way you'll never have to put 20% or 25% down on a property. You'll never have to do it because you're buying a house as an owner occupant. Start off that way. So what, the first house might not be as big as you want it to be. It might not be where you want it to be. May not have the amenities you want it to have. But that's your investment property. Move in it, live in it, you got it, good. And then when your circumstances change and you save money, you got raises on your job, you kind of know exactly where you want to be, you have an idea as to how big your family is going to be. Because let's face it, people do still do family planning. They might, I'm going to get married, want to have children, whatever the case might be. But your circumstances might be better because now that you have a property, or which will become an investment property, the banks will look at that as, oh, wow, okay, they already own real estate. And that can be like your ticket. It's like a token to help you move up to the next level, as it were. So that's just one of the ways that I feel that a lot of people, especially in the African American communities, seems to not take advantage of that when they want to, as far as being able to have investment real estate. So again, sky is a limit. And next week, I'm sorry, not next week, next month, on November 10th, same time, but this time hopefully in person, we're going to talk about estate planning with real estate. And we're going to discuss, as Kevin mentioned, business major credit cards. And we hope and look forward to seeing you. Make sure you like, share, make sure you have your friends and family go on to YouTube and see all of our previous segments that we have done. This makes our 10th segment. So there's 9 that you can really enjoy. And we look forward to being able to see all of you. And if there aren't any additional questions, we want to say goodbye to everybody. But are there any questions? Let's see if there's any questions. All right. All right, one of the questions was, should we invest in a fund? What do you think? So when you say invest in a fund, I need you to be a little bit more clear or specific about what kind of fund you're referring to. Let's see if we can unmute him for a question.
Good morning, everyone. I was talking about fund that manage properties like, ETFs, stuff like that.
Like ETS?
Yes.
Okay, I barely hear, I'm sorry.
So, Luke, are you asking about real estate investment funds, so REITs or REIT ETFs?
Exactly.
Okay, now that I can't speak on, so that might be more in Kevin's warehouse.
Yeah, so for those of you who are not aware, he's speaking of a REIT ETF. REIT stands for Real Estate Investment Trust. ETF stands for Exchange Traded Fund. So an exchange traded fund is where they put a bunch of real estate properties into one fund, just like they bundle stocks. It would be the equivalent of a mutual fund.
Okay.
For real estate. So you put a bunch of properties into a fund, and that diversifies, right? So you may have one property in Detroit, Michigan. You may have another property in Los Angeles, California. And as the market values go up and down, you're hedging your bets. And that is a great way to get into real estate investing. Henry, we don't give financial advice. Let's just be clear about that. This is
right.
We don't offer financial advice. But real estate investment funds are a really good way to get into real estate investing because you don't have to take on the full liability of rehabbing and managing a property. right? Somebody's already doing it. You don't even know where the property is. You just know that you put in $10,000 and they're returning you back. Most of the time, they're returning back dividends, and then your value is going up, hopefully in the marketplace. Does that answer the question?
Oh, we'll have to, right.
Yes, yes, thank you.
Beautiful.
Okay, so we'd like to, on behalf of Kevin and myself, we'd like to thank all of you for attending, and we look forward to being able to see you again, as we discussed next month. And you stay safe out there. Thank you for supporting us as always. We appreciate it.
We appreciate you all. Be well.